What are stocks? Stocks are units of ownership in a company, also known as shares of stock or equities. When you buy a share of stock, you're purchasing a partial ownership stake in a company, entitling you to certain benefits. Understanding what stocks are and how they work is one of the keys to investing, since stocks play a central role in building a well-balanced investment portfolio. Companies raise capital to fund their operations by selling shares of stocks. When companies sell stock, they're inviting investors to purchase a fractional ownership interest in the company, making them part owners. Equity is a way to describe ownership, and equities are an alternative name for stocks. Companies can also issue bonds to raise capital, although buying bonds makes you a creditor without any ownership stake in the company. When you buy shares of stock in a company, you gain certain privileges depending on the types of shares you own, including voting rights. You may have the right to vote at the company's annual shareholder meetings. Dividends. You may receive a share of the company's profits. Capital appreciation. When the company's stock price goes up, your shares increase in value. And when the price of a stock declines, the value of your shares fall. While stocks give you an ownership share in a company, owning shares of stock doesn't mean you're entitled to a say in the company's day-to-day operations. Owning stock means you're trusting the company's leaders to run the business the way they see it fit. If you don't like the performance of a company, you sell your shares and choose a new home for your investment dollars. When private companies decide to sell shares of stock to the general public, they conduct an initial public offering or IPO. When you read that a company is going public, that means they are conducting an IPO where they make shares available for purchase by investors via public stock markets. During an initial public offering, the company and its advisors disclose how many shares of stock will be issued and set an IPO price. Funds raised from the sale of stock during an IPO go directly to the company. Once the offering is complete, the share of stock are traded on the secondary market, otherwise known as the stock market, where the stock's price rises and falls depending on a wide range of factors. What are the different types of stock? Companies issue a variety of different types of stock. Common stock and preferred stock are among the most common varieties, and some companies have different classes of stock. These different types of stock determine voting rights, dividend payments, and your rights for recouping your investment if the company goes into bankruptcy. Common stock versus preferred stock. As noted above, buying stocks may give you the right to vote on issues at a company's annual shareholder meeting. Each share of common stock typically gives holders a single vote at the company's annual meeting. However, common stock shareholders are at the end of the line after debt holders, creditors, and preferred stock shareholders when it comes to recouping their investment should the company go into bankruptcy. Common stock generally entitles you to dividends, however, you are not guaranteed to receive dividend payments. Companies can choose to pay dividends or not pay dividends, depending on their own needs. Shares of preferred stock typically do not give you any voting rights, although preferred stock generally entitles holders to receive dividend payments before common stockholders. In addition, investors who own shares of preferred stock are ahead of those who own common stock in line for recouping their investment should the company go in bankruptcy. Companies frequently issue different classes of stock, often designated with a letter such as A, B, or C. Additional share classes are typically issued with specific voting rights per class and exist to help company founders or executives retain a greater degree of control over the company. Take Alphabet, the holding company that owns Google. Alphabet has three classes of stock. Class A stock gets one vote for each share. Class B stock is held by the company's founders and gets 10 votes per share. Class B shares are not publicly traded and exist to help the founders retain control over the company. Class C stock has no voting rights and is largely held by employees and some common shareholders. Depending on the type of stocks you own, companies may share their profit with you via dividends. Investors receive dividend payments quarterly or annually, with payments allocated based on how many shares of the company's stock you own. Holders of preferred stock have priority claim to dividends ahead of common stock shareholders. Regardless of the type of stocks you own, the principles governing dividends are essentially the same. For example, say a company has positive earnings for the quarter and issues a 42 cents preferred stock dividend. If you own 100 shares of the company's preferred stock, you'll receive a cash dividend of $42. Many companies also offer a dividend reinvestment plan, also known as DRIP, that allows you to reinvest your cash dividend payments back into the stock, expanding your holding and keeping your cash hard at work in your portfolio. Companies sometimes issue stock dividends. If a company declares a stock dividend of 5% and you hold 100 shares of that company, you'd receive 5 additional shares of stock, bringing your holdings to 105 shares. However, the value of each outstanding share would decrease by 5%, making the value of your shares the same. Companies also issue hybrid dividends that are a combination of cash and stock. Hybrid dividends are rare, but have been used in the past by companies as a way of sharing profits with their shareholders. Owning shares of stock gives you the potential to share in the profits of the world's most successful companies. The S&P 500, one of the most common indexes that track stock performance in the US, delivered investors a 7% average annual rate of return, adjusted for inflation, in the period from 1959 to 2009, compared to Barclays US Aggregate Bond Index, which has returned an average of 4.67%. Stock outperformed fixed income investors over the long term. While buying them isn't without risk, investors use stocks as one of the core tools to grow their savings and plan for long-term financial goals like retirement and educational savings. As stock prices go up, so does your saving balances. But be aware that stock prices also go down and sometimes lose all their value and become worthless. There is no guarantee that you'll recoup your investment. Stocks are one of the basic ways to diversify an investment portfolio. Investors buy different stocks in companies, large and small, in a wide variety of industries to help mitigate risk, as different sectors of the economy thrive at different times. For example, a company selling paper products might experience record sales during an economic crisis like COVID-19, whereas an automaker might have below average sales performance. Owning a variety of different stocks can help investors enjoy gains in thriving sectors while offsetting losses in others. Both stocks and bonds play a complementary role in building a dividend investment portfolio. Buying both stocks and bonds help investors capture market gains and protect against losses in a variety of market conditions. If you're looking for long-term growth, having more stocks in your portfolio could be a good strategy, given their historically high rates of return compared to bonds. As the economy grows, public companies grow their revenue and profits, which causes the value of their shares to rise over the long term, and their shareholders reap the benefits. If you're looking for steady income, investing more in bonds might be a better approach. While bonds may have lower long-term rates of return than stocks, a well-chosen portfolio of bonds offers reliable interest payments and lower volatility. The latter is attractive for investors who might be nearing or in retirement who want to preserve capital after their years in the workforce are over. If this video was of value, please feel free to subscribe and join the community. And as always, I'm looking forward for a dialogue with you. So see you down in the comment section. Thank you for watching.